The more houses you have that are owned by people who don't live in them, the greater the chance that there's some type of volatility in the market. Because ultimately, what it means is that there's more external factors at play influencing those homes being listed or not listed that have nothing to do like with the, someone just living in the house. If I just live in my house and maybe I lose my job or I come to tough financial times, I'm going to scratch and claw to stay in my house, right? Like I'm going to scratch and claw to stay in my house. If I own 4 or 5 investment properties that I bought over the last 10 or 15 years, and I run on tough financial times, selling that 4th or 5th investment property is a much easier decision than the other scenario where I'm living in my house and I have to leave my house. And if you don't mind, I actually want to show you another data point that we track here on Reventure app. It's called shadow inventory, which looks at the percentage of houses that are absentee owned units that are seasonally vacant or just completely vacant. We track it by state. You can see the Midwest is kind of very few absentee owned units. There isn't as much speculation there. There isn't as much market downside, but I want to focus on a market like Florida actually, because you can see what's crazy in Florida is that you have you have a market like Naples. 1/3 of all the houses are absentee-owned units. In Sarasota, 18% of all the houses are absentee-owned units. In Miami, where I am right now, 11% are. And if we actually kind of zoom in here on the zip code map, I mean, we could see, you get close to the beach, 50% of the houses are absentee-owned. And so the higher the absentee ownership rate and the shadow inventory rate, and you can see it varies significantly just even within a city, the more downside risk there is. Because think about someone who owns a beach condo or a beach house somewhere in Miami. Their insurance and HOA costs just doubled, right? Their carrying costs just doubled, and it's their 2nd or 3rd house. Very easy for that person to make the decision to sell. And so this represents a lot of potential downside. This represents kind of like you said, the boomers who own 2 or 3 homes, maybe some of them are vacation homes, some of them are rentals. You can see it's a lot of beach destinations, have a lot of absentee ownership. These are markets that actually got hit really hard in the last downturn as well. Wouldn't be surprised if they get hit hard again. And so, yeah, I think there's just so many different angles for inventory to spike, right? The investors, the Airbnbs, the builders, the, like you're saying, the boomer owner that has 4 or 5 properties and they're relying on it for their retirement. There's so many different angles where inventory can spike. And just here's a number for you. There's 27 million investment properties in America, according to Atom Data Solutions. 27 million investor properties in America. That's 1/4 of all houses are investor properties. So it's not even like you need that many investor owners to have issues for inventory to spike. You just need like 5% of them to run into some type of problem for all of a sudden inventory to go up really fast. But of course, totally depends on your city, totally depends on your neighborhood. It's no accident that inventory is going up most in a market like Florida, because that's a market where homeowners are getting crushed by higher insurance costs, higher HOA costs. And so, a market like Florida, you could actually, Fed could cut rates, we could avoid a recession. Florida is going to continue to see inventory spike no matter what, due to these higher costs for homeowners. In some ways, it's kind of similar to what happened in 2008. We had these adjustable rate mortgages. All of a sudden, the cost of the mortgages went up very rapidly. In this case, it's not the cost of the mortgages going up, it's the cost of your insurance and HOA and property taxes all of a sudden going up very rapidly. And this is something that's causing a lot of owners to be forced to sell. This is happening also in Texas. This is happening also in Arizona. This is also happening in Tennessee. And really, a lot of these Sunbelt housing markets is where those costs went up the most, because insurance is heavily a function of the value of the property and of the structure, right? And then property taxes are also a function of the value of the property. So in some of these Sunbelt states, the prices went up 50 or 60% over 3 years. Well, that's going to flow into all those other costs. It's going to flow into your property tax bill and your insurance bill. And actually, someone commented on my YouTube channel once, I thought it was super smart. He said, if I'm living in a house for 30 to 40 years and I don't plan on selling it, he's like, I actually don't want to see the value go up. Because if the value goes up, I know my taxes and insurance are going to go up. If the value doesn't go up, I know my taxes and insurance aren't going to go up as much. And I thought that was super interesting. It's a very counterintuitive point, because I think most people want to see the value of their house go up, right? But from a pure dollars and cents, cash flow and expense angle, rapid appreciation like we saw in the Sun Belt during the pandemic, it actually has high cost and consequence to homeowners in the long run. we're basically 30% overvalued on the US national housing market. I think I'm maybe dialing that projection down a little bit due to the fact that inventory in the Northeast and Midwest is just really stubborn. So like in the Northeast and Midwest, and I'm going to pull up Reventure app here so you can see kind of what I'm talking about. So like in the Northeast and Midwest, right? New York, Pennsylvania, Virginia, like we're like 10% overvalued in these markets, right? So I could see like a 10% correction coming in these areas. The problem is the inventory. We're still at an inventory deficit here, and it's not really improving. So this is, I think, the one thing that surprised me a bit. Like I always knew the Northeast and Midwest would fare better than the Sun Belt, but inventory here is just still so low. Like in Connecticut, I think you've spent some time, Adam, inventory is down 58% from its long-term norm. And so if we're in Connecticut, where before the pandemic, we had 16,000 homes, now we have 3,800 homes. I mean, it's hard for me to project any type of downturn there in this current environment. You know, our forecast score on Reventure app is saying prices are going to go up because of this. Same thing in New Jersey. In New Jersey, we were at 44,000 homes before the pandemic. Now we're at 13,000. And so, you know, we go back to that discussion of housing shortage in the beginning. There is a definite housing shortage in New York and Connecticut. You can't argue, in New Jersey, you can't argue that. And these markets are not as overvalued, 13% overvalued. So I would say at some point in these markets, maybe there's eventually a correction. It will have to take a recession though. It will have to take a recession that dislodges some of that inventory shortage in these markets in the Northeast. Meanwhile, if we go to the Southeast, you can see like Tennessee, Georgia, Florida, home prices are 30% overvalued in these markets. Some of the most overvalued home prices in America, while inventory is now up from the long-term norms in all these markets. So for me, I'm saying in the short term and the long term, these markets are going down due to skyrocketing inventory and the fact that prices are already very overvalued. You can lump Texas into that as well. You can lump Arizona into that, as well as some of these mountain states like Colorado, Utah, and Idaho. Now, the interesting one is California. Inventory in California is still, it's improving, right? We see a bounce back in inventory in California, but we're just now getting to the 7-year average, and we're still below where we were before the pandemic. And so I'm kind of have a stable forecast in California over the next year. We're gonna have to see this inventory get higher, and we're gonna have to see the price cut rate in California get higher as well before we can definitively say prices are on the decline. However, once that happens, home prices across California are around 18% overvalued. To be clear, very expensive no matter what in California. It's always been expensive. They're 18% higher than their long-term norms. And so, and I'm not trying to not give you a national answer, Adam. It's just like, it's hard to give a national answer when there's so many differences in these local housing markets. I do a lot of on-the-ground research and on-the-ground reporting in these local housing markets. I go and find listings on Zillow. I talk to people. I look at the data on Reventure app. And what I'm finding in Miami is a little scary, actually. So the inventory here is going up. Miami-Dade is still in an inventory deficit a little bit. But one thing, I keep talking to locals down here who moved here in the last 1 to 2 years. And the one thing I keep getting is that they are all struggling. Like lots of people who were laid off from their job, lots of people who have like 4 side hustles trying to just make it. And this is more of a qualitative observation, right? It's not rooted in the data, but I'm just seeing it down here. I'm saying to myself, in a real recession, this type of market where the housing demand is coming from, you know, people who just moved here over the last 1 to 2 years without really a plan, this type of market could get crushed in a real recession. Whereas like a market like New York City, home prices in New York City have actually already gone down 20%. But in a market like that, it's like you talk to people, it's like they work for Goldman Sachs and, you know, they work for a tech company that's like pretty large. Like, you know, it's more like, okay, like they have a real job. More and more I talk to people down here in Florida, it's not that way. And there's nothing wrong with that lifestyle, but it just says to me there is more risk for the local housing market from a macro and economic perspective. The other thing I'm noticing too is that the inventory, I mean, it's wild how much the inventory has gone up in certain parts of Florida. So I was just in Cape Coral, which is on the western coast of Florida, and I filmed a video in this zip code, 33993. Take a look at the inventory story here. 3 years ago, there was 76 homes for sale in this zip code. Now there's 800, and you can see it's just crazy how much it's gone up. And so when you see something like this, and you see that the prices have still only gone down like 5% or something, you just know that there's more downside coming. And again, these are kind of like the weakest, most speculative markets get hit first. Tampa St. Pete, I mean, this is a pretty big market, right? Tampa St. Pete. I mean, the inventory in a year, it is almost doubled to now the highest inventory that we've seen since 2017 in a very big market, right? So this is not even just like smaller market, like this is happening in big markets in Florida as well. Yeah, I mean, this says heavy downward price pressure in Tampa. This is the home price forecast score we have on ReventureUp. It's 0 to 100. It's below 50. More likely the prices drop based on these underlying characteristics. And so, yeah, the on-the-ground research here is telling me that there is lots of downside, both from me looking at listings, looking at the data, and then also talking to locals. How do you relate macroeconomic stress and distress to the housing market? I think intuitively people know more job losses, less consumer spending. It's not going to be good for the housing market and home prices. But I want to show you something. It shows just how fragile the housing market is to the mainstream economy. So we have a data point on ReventureUp called inventory as percentage of houses. So you can see how many homes are for sale as a percentage of all the owned homes. So in Texas, right, you know, the inventory is spiked. We're now to 1.4% of all houses on the market, right? In Florida, we're at 2% of all houses on the market. And so understand that the difference between a high inventory environment and a low inventory environment is 1% or 1.5% of the houses. So we're back to 2% in Florida. It's going to be even higher in future months. If there's a recession in Florida and only 1% of homeowners are forced to sell their house, that will destroy this housing market. Look at California. California might even be more exposed. There's only 0.6% of all houses are on the market in California. So if 0.5% of all homeowners in California have some type of issue where they're forced to sell, inventory would double. So understand it's a very narrow margin for error on the housing market versus the real economy, and that we do not need to see that many people face distress to then have huge housing market ramifications. And the one mistake everyone seems to make, a lot of housing analysts make this mistake. They say, oh, this is nothing like 2008. They say, we're not going to see 10 million foreclosures, I should say 4 or 5 million foreclosures again. And that's true. We're not going to see 5 million foreclosures again. But that's not the point. The point is inventory went to such a low level and the prices went up so high that narrow bounces back off that are now having big downward pushes in certain housing markets, and it doesn't take that much for distress to spill into the housing market. So right now the foreclosure rate is around 0.5% of all homes in foreclosure. During the housing bust in 08-09, it went to 4% of all homes in foreclosure. We don't need to hit 4% of all homes in foreclosure to have major issues. If we hit 1.5% of all homes in foreclosure in this cycle, there will be major issues in terms of forced selling and home prices dropping in many markets.